The Credit Market Pulse is the first publication of its kind for the credit risk industry that provides a holistic overview of the health and trends of global credit capital markets, leveraging the extensive analytical intelligence and data from S&P Capital IQ. The second publication is out, and we are here to discuss some of the key findings.
On our second edition, what are the new compelling global trends that investment managers and credit professionals should know? The world credit pendulum is swinging back, favoring developing markets. Following the first edition, the US, Europe, and Asia Mature have continued to converge towards the lowest median probability of default since the beginning of the financial crisis, and they now stand at below 0.1% for the entirety of these developed markets. Going a step deeper, we found an interesting contrast with the US in a steady recovery, leading the charts with a MAP AA- probability of default, and Asia Mature on the other end of the spectrum of the developed markets at a notable lower BBB+, still investment grade though. Interestingly, the BRIC countries, on the other hand, remained at the MAP score of AA- in comparison to our earlier issue of November. However, the numerical probability of default continues to trend upwards, suggesting that this MAP score could continue to move more into the high yield segment.
Okay, into the capital markets, the S&P 500 index has continued to improve, reaching an overall PD of 0.02%. This also holds for most of the S&P 500 sector constituents. Is there a particular sector showing higher risk? Well, industries that contributed negatively to the index continue to be telecoms, with Frontier Communications Corp showing the largest PD of the industry segment, along with telecommunications, consumer discretionary, energy, and utilities pulling the index average PD upwards. Within these sectors, the highest PD levels were recorded by International Game Technology and GameStop Corp at 1.83% and 1.39% PD level respectively, both minor constituents of the consumer discretionary group, however. Whilst the PD for both companies is relatively low, the level is uncharacteristically high or higher than peer constituents and could require some monitoring.
Fair enough. Why do we believe this research is so innovative, and why does it matter? With the fast changing pace of the markets and coming out of what was deemed to be a negative macroeconomic global cycle, keeping the pulse on credit risk is essential. And the reason why S&P Capital IQ Market Signals PD model can help you achieve that lies within the DNA of our sophisticated models that are very efficient at incorporating market volatility into credit risk assessment. Add this with the power of CIQ data and the flow of daily calculated probabilities of default for any company listed in the world capital markets, and then you have an advantage to monitor economies, to monitor and benchmark markets or indexes, and or to manage individual companies' counterparty credit risk.
If you are interested in receiving our Credit Market Pulse, the second edition, which is completed, access our S&P Capital IQ Credit Analytics Solutions website. From both of us,
thank you.
Thank you.